Let's start with a number that is, frankly, just difficult to wrap your head around. $1.25 trillion.
Yeah, it's an astronomical figure.
Right, and that is the current projected capital expenditure from the world's largest tech companies, the hyperscalers, just to build out artificial intelligence infrastructure.
Just for the infrastructure.
Exactly. To put that in perspective, I mean, $1.25 trillion is roughly the entire gross domestic product of a medium-sized developed nation.
Oh, easily.
We are watching the largest, fastest deployment of capital in human history.
Yeah.
All of it being poured into silicon chips, data centers, and, the energy grid required to power them.
Right.
And the immediate question that should pop into your mind is, how on earth is all of this being funded?
Because it certainly isn't just coming out of their checking accounts, right?
Yeah, actually.
The sheer velocity of this capital requirement has basically forced Wall Street into overdrive. To feed this AI gold rush, financial engineers have birthed a completely new financial instrument.
The Collateralized Compute Obligation, or
Oh,
CCO. And that acronym, CCO, is exactly why we were here today. Because for anyone who was paying attention to the markets, nearly 2 decades ago, a massive, opaque, multi-trillion-dollar market of collateralized obligations.
Sounds terrifyingly familiar.
Yeah, it really does. It begs the question, are we just actively repackaging the 2008 subprime mortgage crisis, but this time swapping out suburban houses for racks of NVIDIA GPUs?
It is arguably the single most critical question in global finance right now.
Mm-hmm.
And the stakes, they extend far beyond just the tech sector.
Yeah, they touch everything.
They do. If the plumbing of this new financial architecture is flawed, and there is mounting deeply concerning evidence that it is, the blowback won't just hit Silicon Valley. I mean, it will hit pension funds, global credit markets, the broader economy.
So if you are managing a portfolio trying to navigate your tech startup through the next funding round, or you're simply someone trying to understand the invisible forces shaping our economy, you need to understand exactly what is happening under the hood here. In today's deep dive, we are pulling from a fascinating stack of sources. We've got deep structural finance analyses, SEC filings from major players in the space.
Real raw data.
Right. And crucially, we are going to be anchoring our analysis in the groundbreaking research of Dr. Yogesh Malhotra. We're looking specifically at his frameworks on forward AI versus backward AI, which he recently presented as part of the New York State Capitol cybersecurity training.
And Dr. Malhotra's work is just essential here because he identifies the root of the danger.
The core issue.
Right. The foundational threat we are facing isn't merely that a tech bubble might burst or, that an AI startup might go bankrupt. The genuine systemic threat is a catastrophic flaw in how the financial system is currently measuring and pricing risk in an era of discontinuous change.
Because the quants on Wall Street are basically using math designed for the past to price a future that looks nothing like it.
Exactly. They are applying old physics to a completely new universe.
Right. But before we get into the theoretical math, I want to make sure we ground this in the physical reality of the market right now.
Good idea.
If we want to understand why these instruments might break the system, we have to tear one open and look at the engine. Let's talk about the anatomy of a CCO. What exactly is Wall Street building here?
Well, at its core, a CCO is a structured asset-backed security, an ABS.
Okay.
To really grasp the innovation and the danger, you have to look at the fundamental alchemy Wall Street is performing. They are taking future AI compute demand, right? The theoretical revenue that these chips will generate over the next 5 years.
Okay.
And they are converting it into present-day financial collateral that can be bought, sold, and borrowed against right now.
So it's basically financial time travel. They're pulling the future cash flows of the AI boom into today to pay for the hardware to build it.
That's a great way to put it, yes.
But what actually sits in the vault? What is the collateral? Because when I think of collateral, I think of something physical.
Well, it is physical, but it's not just a warehouse full of graphics cards.
Okay.
The collateral pool for a CCO is it's a complex legal bundle. Yes, it includes the raw GPU hardware, but crucially, it also includes the actual physical real estate leases for the data centers, the massive power purchase agreements required to turn them on.
Because they draw insane amounts of electricity.
Insane amounts. And most importantly, the long-term cloud compute offtake contracts.
Hold on. Let's define an offtake contract for us in this context.
Sure. An offtake contract is essentially a binding long-term agreement where a customer, usually a massive hyperscaler or a well-funded AI lab, agrees to rent a specific amount of compute power for a set number of years.
Right. So it's guaranteed revenue.
Right. Regardless of whether they actually use it all every single day, it guarantees a baseline cash flow to service the debt.
Okay, so Wall Street gathers up this bundle, the chips, the building, the electricity, and the guaranteed rental income. And then what? How do they sell it to investors who, might have vastly different appetites for risk?
They use a mechanism called tranching.
Tranching.
Yeah, this is the cornerstone of structured finance. You take this massive billion-dollar pool of bundled AI debt, and you slice it horizontally into tiers, or tranches.
Got it.
At the very top, you have the senior tranches. These are the slices that are historically rated AAA by the credit agencies.
The supposedly bulletproof investments.
Exactly. The senior tranches get paid first from whatever cash flows the data center generates. Because they're the absolute first in line to get their money, they're taking the lowest mathematical risk.
And in exchange for that safety, they accept the lowest interest rate return.
Right. And this is where the massive conservative pools of capital go. Sovereign wealth funds, global pension funds, insurance companies.
And what happens below that top layer?
Moving down, you hit the mezzanine tranches. These might be rated A or
Right.
BB. They offer a moderately higher yield, but they take on a medium level of risk. If some of those AI startups break their offtake contracts and default, the mezzanine investors start taking losses, but only after the bottom layer is completely wiped out.
And that bottom layer is where the real casino operates, right? The equity tranche.
The equity tranche is the foundation of the stack. It offers incredibly high potential returns, sometimes, in the high double digits.
Wow.
But it is the shock absorber for the entire structure. If the underlying data center misses its revenue targets or the hardware depreciates faster than expected, the equity tranche absorbs the very first wave of losses.
So they are the first to get completely wiped out.
Exactly.
I want to make sure you, the listener, understand that this is not some whiteboard theory being debated at an academic conference. This is happening right now at a massive scale.
Oh, absolutely.
To ground this, the research points us directly to the SEC filings for a company called CoreWeave.
Yeah, CoreWeave is a prime example.
They are a massive specialized cloud provider. They recently executed an $8.5 billion investment-grade rated GPU-backed financing deal.
A massive deal.
And on top of that, they did a separate $3.1 billion publicly syndicated facility. We're talking about nearly $12 billion moving through this exact architecture for just one company.
Right. And CoreWeave is the perfect case study here because it illuminates how the actual architecture of tech finance has fundamentally mutated.
How so?
Well, think about 5 years ago. If a tech company wanted to buy hardware, they used their own revenue or they raised venture capital equity, and they bought the servers outright. It was a direct, simple transaction between a buyer and a seller.
But at a $1.25 trillion scale, venture capital isn't big enough anymore.
Exactly. Venture capital is a puddle compared to the ocean of the global debt markets. So to tap into that ocean, the new era of AI finance relies on a complex intermediary structure. Instead of a tech company buying GPUs, investor capital flows into something called a special purpose vehicle, or an SPV.
An SPV? This sounds like financial dark arts. What is the actual function of an SPV here?
An SPV is a completely separate, distinct legal entity created for one single financial transaction. It is designed to be what Wall Street calls bankruptcy remote.
Meaning, if the parent company blows up, the SPV is theoretically safe.
That is the idea. The SPV takes the billions of dollars from the pension funds and hedge funds, and the SPV itself buys the thousands of GPUs from NVIDIA.
Okay, I follow.
The SPV then turns around and leases those exact same GPUs back to a hyperscaler or a cloud provider on a strict multi-year contract.
That SPV buys 100,000 Ford Mustangs. It then leases them to Hertz for 5 years. Wall Street then takes the promise of those daily rental fees from drivers, combines it with what they mathematically project they can sell those used Mustangs for in 5 years, bundles it all together, and sells slices of that massive income stream to, a teacher's pension fund in Ohio.
Exactly.
That is essentially what is happening with AI compute right now.
It is a phenomenal analogy.
Yeah.
But we have to introduce a vital caveat that the deep dive reports explicitly warn about.
Okay, what's the catch?
Right now, the term CCO is still largely a media shorthand. Unlike the highly standardized collateralized loan obligation or CLO market, the CCO market isn't a monolithic, perfectly uniform asset class yet.
So it's the Wild West. Every deal is bespoke.
Precisely. The immediate terrifying danger isn't that there is a secret, fully mature $500 billion toxic CCO market hiding in the shadows ready to detonate tomorrow. The true danger is that the global financial system is aggressively and blindly accumulating the raw ingredients, the legal structures, and the flawed risk models from which a massive systemic crisis will inevitably emerge.
They are pouring the concrete for a financial reactor without understanding the physics of a meltdown.
That's exactly it.
Which naturally brings us to the ghost haunting every single conversation about tranching and structured finance. 2008.
Oh, absolutely.
The moment you say the words SPV and tranche, anyone who lived through the great financial crisis feels a cold sweat. The structure of these new CCOs looks nearly identical to the collateralized debt obligations, the CDOs, that almost broke the world.
They really do.
Wall Street took subprime mortgages, bundled them, tranched them, called the top layer AAA, and sold them to the world. When the underlying mortgages defaulted, the whole tower collapsed.
The structural legal blueprint is undeniably the same. The machinery of securitization hasn't changed. But, and this is where we have to be incredibly precise, if you map the 2008 housing blueprint directly onto the 2026 AI infrastructure landscape, you start to see a terrifying divergence.
Interesting.
The differences are actually much scarier than the similarities.
Let's pull on that thread. Let's compare them head to head. In 2008, the underlying asset at the very bottom of the CDO was a subprime mortgage attached to a physical house in a suburb. In 2026, the underlying asset is a rack of AI GPUs sitting in a data center.
Right. And the first glaring difference is concentration risk. In 2008, the risk was fundamentally geographic.
Oh, bro.
You had mortgage pools that were heavily concentrated in the housing markets of specific overheated regions, places like Miami, Florida, or Las Vegas. When those specific regional economies faltered, the high correlation of defaults killed the CDOs backed by them.
But it was still dispersed across millions of individual homeowners.
Right.
Right. If a factory closes in Ohio, it doesn't necessarily mean people stop paying their mortgages in Texas.
Right.
But now, with AI, the concentration risk is just mind-boggling. The sources highlight that roughly 70% of all high-end AI GPUs on the planet are manufactured by a single solitary company, NVIDIA.
It's a massive bottleneck.
And on the demand side, it's just as choked. About 80% of the entire global demand for these chips is driven by just 4 hyperscalers: Microsoft, Google, Meta, and Amazon.
It is an extreme, almost unprecedented lack of diversification. If there is a single supply chain shock in Taiwan, or a single massive shift in capital allocation strategy in the boardroom of one of those 4 hyperscalers, the correlation of default across the entire ecosystem approaches 100%.
But wait, I want to push back on this a little bit. Even with that concentration risk, isn't the core issue still the collateral itself?
How do you mean?
Let's go back to my house analogy. With a 2008 subprime mortgage, if the borrower lost their job and defaulted, the bank foreclosed. The bank took the house. Now, the house might have dropped 30% in market value, which is bad, but it is still fundamentally a house.
Right.
It has doors, a roof, plumbing. It has inherent persistent utility. You can live in it. It keeps the rain off your head. Eventually, someone will buy it because humans need shelter.
You have just articulated the single most dangerous flaw in the entire CCO market.
Really?
The assumption of persistent utility.
Because if an AI startup defaults on their compute lease 18 months from now, the bank doesn't get a house. The SPV forecloses, and they get a rack of GPUs. Are you telling me that these brilliant quants are relying on collateral that might essentially become high-tech paperweights just because NVIDIA releases the next generation of chips?
That is exactly what is happening, and it is the absolute crux of the systemic problem. A house provides shelter indefinitely. A GPU is what financial analysts call an accelerating obsolescence asset.
Walk us through the physics and economics of that obsolescence. Why does a chip become worthless so fast? I mean, it can still do math, right?
It can still do math, yes. But AI compute is entirely a game of energy efficiency and performance per watt.
Okay.
Let's look at the reality of silicon development. A state-of-the-art GPU minted today might be the most productive, powerful, highly sought-after piece of technology on the planet. Startups will pay premium rates to rent it.
Sure.
But in 12 to 18 months, when the radically more efficient successor architectures, the generations following Blackwell or Hopper hit the market, everything changes.
Because the new chips are just faster.
They are faster, but more importantly, they're vastly more energy efficient. A data center's primary operating cost is electricity.
Right.
When the new generation of chips arrives, the older GPU becomes utterly uncompetitive. The sheer amount of electricity required to power and cool that older chip in order to generate a single token of AI output will mathematically outstrip the economic value of that token.
Wait, I want to make sure I understand this. You were saying that in 18 months, it might literally cost more money in electricity bills to turn the old GPU on than you could possibly make by renting its processing power to a customer.
Precisely. Its economic utility drops below zero. It becomes a liability to operate.
Wow.
Now bring this back to the Wall Street quantitative models pricing these AAA CCOs. The standard models used to rate structured debt borrow heavily from historical data on corporate loans or commercial aviation leases. They routinely assume a historical recovery rate of 40 to 60% for collateral in the event of a default.
So they assume they can just repo the servers and sell them on eBay for half price.
Exactly. But for obsolete, massively power-hungry tech hardware sitting in a bespoke data center, the true secondary market recovery rate in a distressed, flooded market could be near zero.
There's no buyer.
There is no bid. Nobody wants an inefficient chip.
That is a terrifying realization. If the hardware loses its value so incredibly fast, then what is actually backing the investment? What are these massive pension funds actually buying?
This leads us directly into a vital distinction that the sources, particularly the deep dive structured finance analyses, insist every single risk manager must make. You have to separate the underwriting cases.
Right. Because if you peel back the complex legal layers of a CCO, you find that there are fundamentally two completely different ways these deals are justified.
We can categorize them as Case A and Case B, and confusing the two is a recipe for a disaster.
Let's break them down. Case A.
Case A is the genuine asset-backed scenario. In this model, if everything goes wrong and the borrower defaults, the financial recovery of your investment depends entirely on the SPV's ability to legally repossess the GPU hardware, physically remove it from the data center, find a willing buyer in the secondary market, and resell it.
Which, based on what we just discussed about obsolescence, sounds like a nightmare.
It requires an almost impossible level of foresight. To underwrite Case A safely, a risk manager needs a flawless, predictive analysis of secondary market spot prices, future global power costs, network topology compatibility, because you can't just plug these chips into any old motherboard.
Right.
And most importantly, the exact, precise curve of technological obsolescence from competitors who guard their roadmaps like state secrets.
Okay, so Case A is a massive gamble on the resale value of rapidly decaying silicon. What is Case B?
Case B is the contract-backed scenario. In this case, the underwriting model essentially ignores the resale value of the hardware.
Interesting.
The recovery strategy depends entirely on the customer, usually an incredibly well-capitalized tech giant, making their recurring, ironclad lease payments month after month, year after year, regardless of whether the hardware inside the data center is obsolete.
So they are on the hook to pay the rent, even if they aren't using the servers anymore.
Correct. Underwriting Case B has nothing to do with physics or silicon. It requires deeply analyzing the customer's corporate creditworthiness. It means hiring teams of lawyers to comb through the specific termination rights hidden on page 400 of the contract.
Wow.
Are there hell or high water clauses? Are there minimum payment obligations that survive a change in corporate strategy?
So here is the sleight of hand. An investment bank might market a new CCO product with a big, shiny label that says asset-backed. That makes the pension fund managers feel warm and fuzzy because they associate asset-backed with things like mortgages or airplanes things with persistent value.
Exactly.
But in reality, the survival of the CCO might depend entirely on Case B. It depends entirely on two tech giants in Silicon Valley not simply changing their minds about their AI strategy and deciding to eat the legal penalty for breaking a contract.
You have hit the nail on the head. Wall Street is blurring the line between collateral risk and counterparty credit risk. And this leads to an extremely dangerous phenomenon that the sources call correlation masquerading as diversification.
I want to visualize this for the listener. Say I'm a risk manager looking at a spreadsheet for a new CCO pool. It looks beautiful. It contains dozens of distinct, legally separate entities. I see 20 different AI startups, 5 different regional cloud providers, 3 infrastructure firms.
Looks safe, right?
Yeah, the risk looks incredibly spread out. If one startup fails, who cares? I have 40 other companies paying their bills.
It looks robust on paper. But you have to ask why those companies exist. If all of those dozens of seemingly independent entities ultimately rely on the exact same underlying macroeconomic assumption, the assumption that global AI demand and revenue will continue to grow exponentially forever, then the diversification is a complete mirage.
Because they're all downstream from the same river.
Exactly. What if 80% of those startups are just building wrappers around a single dominant foundational model from one major AI lab?
Oh, wow.
Right. If that lab abruptly changes its pricing structure, or if a new open source model renders their specific niche obsolete, every single one of those independent entities will face an existential crisis simultaneously. If that single foundational assumption of endless profitable AI growth falters, the correlation goes to 1. They will all default at the exact same time.
So we don't even need a catastrophic, apocalyptic AI winter to collapse this house of cards. The tech doesn't have to stop working. The economics just have to get slightly less magical.
Precisely. The structured finance sources run a mathematical stress test scenario on these CCO tranches that is chillingly plausible. You don't need a total macroeconomic collapse. All it takes is a 15 to 25% drop in overall data center utilization, combined with a 30% drop in the spot price of compute power.
Because supply finally catches up with demand.
Right, and a 40% drop in the residual resale value of the GPUs.
Honestly, a 30% price correction in a hyperinflated tech market is completely normal. We see that in memory chips all the time.
It is entirely normal for a standard semiconductor tech cycle.
Yeah.
Yet, because of the massive leverage in the fragile tranching structure, that specific, relatively mild combination is enough to completely wipe out the equity and mezzanine cushions of a CCO. The SPV goes bankrupt long before any formal corporate bankruptcy of the parent hyperscaler is ever filed.
Okay, this is where the plot thickens. We have established that Wall Street has built a towering, incredibly fragile, multi-billion-dollar structure out of rapidly depreciating, power-hungry assets. What happens when the smart money, the massive hedge funds, the institutional risk managers start to realize that the foundational math holding it all up is flawed?
Well, they do what Wall Street always does when they see a fire hazard. They buy fire insurance.
Right. But in this specific, highly leveraged market, the insurance itself might be the very spark that burns the whole system to the ground.
You're talking about the derivatives market, specifically credit default swaps, or CDS. And you are correct. In a fragile ecosystem, derivatives act as a massive accelerant to systemic contagion.
For those who don't trade exotic derivatives daily, let's define this clearly. In this context, a credit default swap is essentially an insurance contract. The buyer of the CDS pays a regular, ongoing premium, known as a spread to the seller. What the buyer gets in return is protection against a specific financial event, like a CCO tranche defaulting. If the CCO blows up and goes to zero, the seller of the CDS has to step up and pay out a massive lump sum to the buyer to cover the loss.
On surface, if you own the underlying CCO bond, buying a CDS is a perfectly valid, responsible hedging tool. It's like buying car insurance for a car you actually own and drive. But the profound danger lies in something called the naked CDS.
Naked CDS, even the name sounds reckless.
It is arguably one of the most destabilizing financial inventions in modern history. A naked CDS is when investors, usually highly leveraged hedge funds, place speculative bets against CCOs without actually owning any of the underlying AI assets.
So using the insurance analogy, they are basically buying massive fire insurance policies on a neighbor's house, a house they don't own, and then just sitting on the porch hoping it burns down so they can collect a massive payout.
Exactly. And because they don't have to buy the actual underlying billion-dollar asset, the leverage is astronomical. They can place a $100 million bet that only costs them a few $100,000 in premiums. And the deep dive sources draw a direct, screaming, unavoidable parallel to the collapse of AIG in 2008.
AIG, American International Group, the insurance giant that nearly took down the global economy single-handedly. How does that parallel work here?
In the lead up to 2008, AIG's financial products division sold over $500 billion in CDS protection on subprime mortgage CDOs.
$500 billion.
Right. They were happily collecting the premiums from Wall Street banks who were betting against the housing market. But AIG did not hold anywhere near enough actual capital in reserve to cover those payouts if the housing market actually turned. Their quantitative models told them a nationwide housing collapse was statistically impossible.
And then the statistically impossible happened.
When the CDOs defaulted en masse, AIG was instantly on the hook for billions of dollars they didn't have. Because AIG was the counterparty to almost every major global bank, their failure would have instantly bankrupted the entire financial system. It required a $182 billion bailout from the U.S. taxpayer to save them.
So applying that to today, the fear is that right now, hedge funds, shadow banks, and institutions are eagerly writing billions and billions of dollars in naked CDS contracts against AI infrastructure, blindly assuming that tech growth is inevitable, without having the actual capital reserves to back it up if the tech cycle turns.
That is the systemic nightmare scenario. And the complexity of this new derivative architecture makes it incredibly difficult for regulators to track. The sources map out a 5-layer transmission channel for how this CDS contagion would spread through the global financial system. It's a cascading failure mechanism.
Turn that list into a narrative for us. Let's imagine the dominoes falling. How does a problem in a data center infect the global banking system? Start with layer 1.
Layer 1 is corporate CDS. Imagine a hedge fund sees the obsolescence risk we discussed, and they decide to place a simple, direct hedge against the massive hyperscalers or the neocloud providers themselves. They buy a CDS on the parent company's corporate debt. If the company struggles, CDS pays out.
Okay, that's a direct bet against the giant. What is layer 2?
Layer 2 gets more granular. It is asset-backed protection. Here, the hedges aren't placed against the giant parent company. They are placed specifically against the debt of those isolated special-purpose vehicles, the SPVs that own the physical compute facilities.
So betting that the specific rental car fleet goes bankrupt, even if the Ford Motor Company survives.
Exactly. Then the contagion moves to layer 3, which is tranche protection. This is where investors buy bespoke insurance against a very specific slice of the risk. A fund might buy a CDS solely on the mezzanine tranche of a specific CoreWeave CCO, betting that the middle layer will get wiped out while the senior tranche survives.
The slicing and dicing gets finer. What about layer 4?
Layer 4 is where it becomes massive again. Portfolio protection. Investment banks create bespoke baskets consisting of dozens of different compute providers, SPVs, and AI startups, and they sell insurance that covers the entire group.
Oh.
This is where the false assumption of diversification becomes deadly.
And finally, layer 5. You mentioned this earlier, and it always sounds like the harbinger of doom.
Layer 5 is synthetic exposure. This is the absolute peak of financial engineering detachment. In Layer 5, investment banks create entirely new structured notes that derive their value purely from a mathematical reference portfolio of CCOs via CDS contracts.
Wait, explain that clearly. There are no actual chips?
No actual chips.
Right.
No data centers, no electricity, not a single GPU ever changes hands. It is a purely synthetic derivative structure, a side bet on the performance of other bets. It is pure derivative speculation, multiplying the leverage in the system tenfold.
This is staggering complexity. But if I am a trader heavily involved in this and I'm buying all these different layers of insurance, I have to ask, does this insurance actually work? Because you mentioned a massive blind spot earlier called basis risk. What exactly is basis risk in the context of an AI collapse?
Basis risk is the terrifying realization that the expensive insurance policy you bought doesn't actually legally cover the specific disaster that just destroyed your portfolio. It is the mismatch between the hedge and the underlying exposure.
Give me a concrete example. How do I insure the wrong house?
Let's say you are a portfolio manager with heavy exposure to the AI sector. You are worried about the obsolescence risk of GPUs, so you decide to hedge. You go to layer 1 and you short a massive hyperscaler by buying a CDS against their corporate debt. You sleep well at night, thinking you are protected from an AI crash.
Makes sense. If AI crashes, the hyperscaler crashes, and my insurance pays out.
But here is the basis risk scenario. A few months later, the price of GPU rentals plummets because a radically new chip architecture is released. The SPV that you actually own the debt in goes bankrupt because it can't lease its old chips for enough money to cover its interest payments. You lose your entire investment in the SPV.
But my insurance policy on the hyperscaler pays out, right?
No, it doesn't.
What? Why not?
Because the hyperscaler is completely fine. The hyperscaler simply broke their lease with a bankrupt SPV, paid a small legal penalty out of their massive cash reserves, and immediately signed a new lease with a different company that has the newer, faster chips. The hyperscaler's corporate debt never defaulted, so your CDS on the hyperscaler is worthless.
Oh, wow.
Yeah, the entity you insured survived. The entity you were exposed to died. You insured the wrong entity against the wrong event. That is basis risk, and will destroy highly leveraged funds in an AI downturn.
So people point to these CDS spreads, the cost of buying this insurance in the market, as an early warning system. They say, look, the spreads are narrow, the market isn't worried. But what you're saying is that these signals are deeply flawed.
As the deep dive sources explicitly point out, CDS spreads are a contemporaneous risk price. They only tell you what the market's aggregate fear level is today based on historical data. They are a thermometer, not a crystal ball. They cannot predict the sudden, discontinuous technological leap tomorrow.
Okay, we have meticulously mapped out the incredibly complex, highly fragile, heavily leveraged financial machinery of the CCO market. The SPVs, the tranches, the obsolescence risk, the synthetic CDS contagion.
Right.
But if you step back from the ledger, you have to ask the biggest, most fundamental question of all. Why? Why are these brilliant Wall Street quantitative models built by massive teams of PhDs from MIT and Stanford failing so spectacularly to see the blindingly obvious danger of tech obsolescence?
And to answer that why, we have to fundamentally shift our perspective. We have to move away from the mechanics of financial engineering and dive into the underlying philosophy of artificial intelligence, algorithms, and risk management itself.
Okay.
This is where we bring in the groundbreaking, vital work of Dr. Yogesh Malhotra. Because the harsh truth is, the algorithms that Wall Street is using to price this massive global risk are hopelessly trapped in the past.
Dr. Malhotra introduces a critical framework here, and it centers on a concept he calls backward AI. Let's dissect this. According to the New York State Capitol cybersecurity training materials and the extensive research provided in our sources, today's most celebrated state-of-the-art AI, the generative AI, the massive large language models like ChatGPT, and the core reinforcement learning algorithms powering them, they all suffer from a singular, fatal flaw when it comes to risk management.
To understand the flaw, you have to look at the mathematical engines running them. Dr. Malhotra specifically points to mechanisms like stochastic gradient descent and backpropagation.
Stop right there. For those of us who don't have a PhD in computer science, what is stochastic gradient descent and why does it make these AI models dangerous in finance?
I won't get bogged down in the calculus,
Yeah.
but conceptually, stochastic gradient descent is an optimization algorithm. It is how a neural network learns.
Right.
It looks at a massive mountain of historical data, makes a guess, measures how wrong its guess was compared to the historical answer, that's the gradient, and then takes a tiny step backwards to adjust its weights to be slightly less wrong the next time.
It's essentially drawing a progressively better line of best fit through a cloud of historical data points.
Exactly. And the key word there is historical. These algorithms rely strictly on historical data, statistical pattern matching, and historical correlation. They are magnificent, unprecedented engines for analyzing and summarizing what has already happened. But they are fundamentally, mathematically incapable of reasoning about what has never happened. And this brings us to a foundational concept in economics, originally articulated by Frank H. Knight in 1921, known as Knightian uncertainty.
This is a crucial distinction. What is the difference between standard risk, which Wall Street manages every day, and Knightian uncertainty?
It is the profound difference between a casino and an unmapped jungle.
Oh, I like that.
Measurable, probabilistic risk, the kind Wall Street models excel at, is like sitting at a roulette table or rolling a six-sided die. You do not know the outcome of the very next roll, but you know exactly what all the possible outcomes are, numbers 1 through 6. And you know the exact immutable statistical probability of each outcome occurring.
So with enough data, you can build a mathematically perfect risk model for a casino.
You can calculate the house edge to the decimal, but Knightian uncertainty is entirely different.
Right.
Knightian uncertainty is true, unmeasurable uncertainty. It describes a highly complex environment where you not only do not know the probabilities of the outcomes, you don't even know what all the possible outcomes might be. The rules of the game are shifting while you are playing it.
So trying to predict an unprecedented technological paradigm shift like attempting to perfectly model the exact obsolescence curve of a quantum-augmented AI chip that hasn't even been invented yet, operating on an energy grid that hasn't been built yet, that isn't risk. That is Knightian uncertainty.
Precisely. And this is Dr. Malhotra's core thesis regarding financial catastrophe. Applying backward AI algorithms entirely dependent on finding patterns in historical data to a domain of true Knightian uncertainty is worse than useless. It is actively destructive.
Because it gives you a false sense of mathematical certainty about the unknowable.
Exactly. Dr. Malhotra argues that backward AI is literally designed to fail in environments of radical discontinuous change. When the future abruptly and violently stops resembling the past, relying on historical correlations leads to predictable, catastrophic failures.
Wow.
You simply cannot take the historical gentle depreciation curve of a 2018 enterprise server rack and use it to price the systemic risk of a multi-billion-dollar 2026 AI GPU cluster. The physics have changed.
I want to give the listener an analogy that perfectly captures this terrifying dynamic. It sounds exactly like Wall Street is driving a high-performance sports car at 150 miles an hour down a winding mountain road. but the driver has covered the windshield with black paint and is strictly navigating by looking exclusively in the rearview mirror.
That is a phenomenal visual, yes.
Backward AI, powered by massive LLMs, can render a flawless, high-definition, perfectly categorized image of exactly what the road behind you looked like 3 seconds ago. But because it is only looking backward, it has absolutely no idea that there is a massive cliff 100 yards in front of you.
And that is exactly what is happening with the CCO crisis. The quantitative models, the algorithmic engines that are currently slapping AAA ratings on these massive financial tranches are inherently assuming a steady state. They are assuming the technology cycle will behave like the real estate cycle, or at worst, the traditional telecom cycle. But the global AI boom does not operate in a steady state. It operates in a domain of dynamic, adversarial, and quantum scale uncertainty.
Okay, this is the pivotal moment. If looking in the rearview mirror leads to catastrophic failure and drives us off the cliff, how do we scrape the paint off the windshield?
Right.
How do we look forward? How do we survive this era of discontinuous change? This is where Dr. Malhotra's frameworks offer a massive paradigm-shifting pivot for risk management. We have to move away from historical data-driven prediction and move toward outcomes-driven anticipation.
This is the critical transition to what Dr. Malhotra terms forward AI, and it requires a fundamental rewiring of how we think about intelligence. Forward AI discards the heavy reliance on historical statistical correlation. Instead, it is built on the rigorous foundations of causal reasoning and what he brilliantly terms the anticipation of surprise.
Anticipation of surprise. I love the phrasing. It implicitly acknowledges that the unknown is not an anomaly. The unknown is the baseline reality.
Exactly. It's about constructing potential, unprecedented futures. It is about building agile systems that adapt to novelty in real time, rather than rigid statistical systems that merely extrapolate from the past and shatter the moment the underlying pattern changes.
And the physical architectural realization of this forward AI concept in Dr. Malhotra's work are what he calls QASANs. Quantum Augmented Self-Adaptive Networks. Now, the sources describe these post-AI quantum systems as being positioned literally decades ahead of the current GenAI and LLM transformers that the entire world is currently obsessed with.
Yes.
But I need you to demystify this. Quantum Augmented Self-Adaptive Networks sounds intensely complex. How does a QASAN actually work without relying on historical data? What math is it doing?
It is a profound architectural difference. A standard LLM, a backward AI, measures its success by tokens burned, how efficiently it can process massive amounts of historical text to predict the most statistically probable next word in a sequence. It's a probabilistic parrot.
Right. It doesn't actually understand the word. It just knows it usually comes next.
Exactly. But a QASAN, grounded in forward AI principles, does not rely on finding historical patterns. Instead, it utilizes causal modeling, physics-based constraints, and real-time adversarial game theory. It maps out the actual cause and effect relationships within a system.
Oh, that makes sense.
And crucially, it measures success not by tokens processed, but by tangible business ROI and assured outcomes in the physical world.
So instead of a rigid statistical model just breaking and throwing in error code when the real world suddenly stops matching its training data, like when a new chip makes the old ones obsolete overnight, a QASAN actually expects the world to change, and it dynamically adapts its risk weighting in real time based on new causal inputs.
That is the core innovation. It is the fundamental difference between fragile, backward-looking statistical models and human-centered, meaning-aware adaptive networks. A QASAN constantly tests its own hypotheses against reality. It doesn't just ingest data. It seeks to understand the causal mechanisms driving the discontinuous change.
And we must emphasize that this isn't just theoretical academic white paper philosophy. The sources explicitly note that Dr. Malhotra's QASAN frameworks and his anticipation of surprise methodologies have been rigorously validated at the absolute highest levels of operational risk.
Yes, across the Pentagon, at MIT, and deep within Wall Street's most advanced risk management departments.
Because the entities operating at those levels, military command and control during a cyber war or global financial clearinghouses during a liquidity crisis, they exist in a permanent, undeniable state of nation uncertainty.
They absolutely do.
They cannot afford predictable, catastrophic failures based on bad historical data. They require assured outcomes regardless of what novel threat appears.
As I said.
So, understanding forward AI, grasping the limitations of backward AI, and recognizing the power of QASANs is intellectually fascinating. But for the listener right now, how do you actually apply this? How do you protect your portfolio, your business, or perhaps even profit from the potential fallout of this CCO house of cards we've spent the last hour outlining?
This brings us to a highly actionable, incredibly powerful concept introduced in the sources: model risk arbitrage.
Model risk arbitrage. That sounds like finding the glitch in the matrix.
It is exactly that. Model risk arbitrage is the practice of systematically exploiting the inherent, predictable blind spots of legacy risk models.
Okay, how does that work?
Let me explain the setup. When the entire broader market, the rating agencies, the massive passive funds, is aggressively using flawed backward AI to price an asset based on historical tech cycles, and you are utilizing forward AI principles to understand the true causal risk of obsolescence, you possess an incredible asymmetrical informational advantage.
You can see the cliff and you know exactly when the market is going to drive off it. Let's break this down into concrete, actionable steps for different stakeholders listening today. Let's start with investors, the people managing capital. What should they do right now regarding AI infrastructure debt?
For investors, the immediate non-negotiable directive derived from forward AI principles is to avoid CCO equity tranches entirely. Do not chase the yield.
Because of the obsolescence risk.
Yes. The discontinuous obsolescence risk of the underlying GPUs is simply too high, too chaotic, and too unpredictable to safely inhabit the lowest layer of the capital stack.
The shock absorber will break. What else?
Furthermore, investors must actively refuse to accept blended risk models from investment banks. You must demand that your analysts underwrite the cash flow dependency, meaning the strength and legal ironclad nature of the customer contract, case B, and the residual hardware value, case A, entirely separately.
Right. Do not let the bankers blur the lines to make the model look safer than it is.
Exactly. Demand transparency between the collateral and the counterparty.
Okay, what about traders? The people actively moving in and out of the derivatives markets.
Traders need to stop looking at single data points in isolation. If you rely solely on CDS spreads to gauge fear, you are looking in the rearview mirror alongside the rest of the market. Forward AI demands multidimensional awareness. Traders must monitor cross-market signals simultaneously to spot the friction.
Give me an example of the friction. What are we watching?
You have to watch the CDS spreads, yes. But you must cross-reference those against bond option-adjusted spreads, the actual real-time spot pricing of GPUs in the secondary hardware market, and real-time data center utilization rates all at once.
Wait, you mentioned bond option adjusted spreads, or OAS. We haven't defined that. What exactly is an OAS measuring here, and why is it a better signal?
It's a vital metric. A standard bond spread just measures the difference in yield between a corporate bond and a risk-free government bond. But an option-adjusted spread mathematically accounts for any embedded options within the debt contract.
Like what?
For example, if the AI startup has the option to prepay the loan early, or if the hyperscaler has a complex cancellation clause in their lease, the OAS adjusts the risk profile to account for the probability that they will exercise those options.
Ah, so it actually attempts to price in the escape hatches hidden in the contracts.
Exactly. And the true signal of an impending crisis, the model risk arbitrage opportunity, will appear in the friction, the divergence between those different markets.
So when the CDS spread says everything is fine,
But the option-adjusted spread is widening because the smart money is pricing in contract cancellations, and secondary GPU prices are quietly plummeting. That is the anticipation of surprise. That is when you strike.
incredible. And finally, what about the policymakers, the regulators who are supposed to be watching the system to prevent 2008 from happening all over again?
The sources outline critical, immediate regulatory steps. First, policymakers must act on the derivatives market. They must impose central counterparty, or CCP, clearing for all CCO-related credit default swaps.
Meaning they force all these opaque bilateral bets into a central, heavily regulated clearinghouse.
Yes. It brings the shadow market into the light. It drastically reduces the AIG-style counterparty risk, where one massive hidden failure takes down a dozen interconnected banks.
That makes sense.
Second, and perhaps most importantly, regulators must mandate extreme stress tests for these SPVs. And these tests cannot use historical corporate default rates. They must explicitly model aggressive, discontinuous GPU obsolescence curves. They have to test for the cliff.
It's all about using the anticipation of surprise to gain the edge. By applying these forward AI principles, a stakeholder, whether an investor, a trader, or a regulator, can detect precisely when the standard market models are dangerously relying on flawed historical correlations.
Exactly.
You can anticipate the discontinuous shock that the algorithmic market doesn't see coming, and you can structure your positions to survive and profit when the market's predictive models inevitably break.
That is the essence of surviving niche and uncertainty. You don't foolishly try to perfectly predict the unpredictable. You build systems, portfolios, and mindsets that are inherently resilient to surprise. You advance beyond historical principles and adopt dynamic quantums for an adversarial world.
Okay, let's bring this all together. We have covered an incredible amount of ground today, navigating the absolute bleeding edge of global finance and artificial intelligence. We started by mapping Wall Street's audacious creation of collateralized compute obligations.
The financial alchemy turning future AI demand into present-day, tradable collateral via complex special-purpose vehicles.
We then exposed the fatal physical flaw hidden deep within those tranches, the accelerating obsolescence of GPU hardware.
Right. We established why a chip is fundamentally different and far more dangerous as collateral than the persistent utility of the real estate backing the 2008 CDOs.
We examined the systemic, terrifying accelerant of naked credit default swaps, breaking down exactly how unanchored synthetic derivative speculation and basis risk could easily turn a localized tech correction into a cascading global financial contagion.
And most importantly, we explored why the current multi-trillion-dollar models fail. We unpacked Dr. Yogesh Malhotra's vital distinction between backward AI, which relies blindly on historical correlation, and forward AI and QA sands.
Right.
We learned how causal reasoning and the anticipation of surprise are the only reliable ways to navigate true niche and uncertainty.
So, as we wrap up this deep dive, we want to remind you, whether you are managing a massive institutional portfolio, building a scrappy tech startup, or just trying to navigate your own career and investments in this rapidly shifting economy, trusting historical data in an era of unprecedented quantum-level technological change is a recipe for absolute disaster.
That really is.
You cannot drive 150 miles an hour while staring intently into the rearview mirror. You must anticipate surprise.
The legacy statistical models will break. That is a mathematical certainty. The only question is whether you will break with them or whether you will adapt and embrace forward AI principles to achieve assured outcomes.
And we want to leave you with a final, lingering, provocative thought to mull over today, something that builds on everything we've discussed, but points to an even larger shadow looming over the market. The most genuine, terrifying systemic risk right now isn't just the specific financial acronym, CCO. It is the terrifying possibility that the entire global financial system is currently taking the exact same singular expectation of endless, exponential future AI growth, and they are capitalizing it multiple times over across the entire economy. That single assumption is holding up massive customer contracts, trillion-dollar infrastructure valuations, private credit debt, and highly complex structured securities. If that one single fragile expectation of endless growth wavers even slightly, what happens to the house of cards built on evaporating silicon?